Good morning, everybody. It's Thursday, August 15th, 5:25 a.m. Central Time. Grain markets are higher this morning. December corn futures up 1 at 401 and 3/4. November soybeans up 6 at 974 and a half. December Chicago wheat up 6 at 562 and a quarter. December Kansas City wheat up 7 at 568 and a quarter. December spring wheat up 7.5 at 616 and a quarter. Let's start off with this Brazil drought story.
So it appears that the drought in the Amazon region is more severe than last year. According to one of the largest Brazilian barge operators, the situation will be challenging once again for grain shipments. With reduced water levels on the Amazon River, grain shipments will need to be split into smaller volumes, reducing efficiency and increasing costs for shipping companies. Additionally, shipments will move at a reduced pace. In June, the Brazilian government announced that it would provide about $90 million to dredge sections of the Amazon River in hopes of keeping it navigable.
Drought in Brazil sounds scary. There's a lot of context here, though. So this is the dry season in Brazil. I pulled a map of the average rainfall of one city in Mato Grosso, and it's pretty similar across the country. May through September is the dry season. The rains typically kick on again in October, November. As far as the Amazon basin and the river is concerned, this map may be hard to read if you guys are watching, but that big green stuff in the north to northwest part of the country, that's the Amazon basin. And most of your key soybean growing areas are south to southeast of there. This was a quote from USDA regarding ports and shipments. The southern ports of Santos, Rio Grande, Paranagua, and São Francisco do Sul, pardon my Spanish, still dominate the soybean trade to China, collectively accounting for 69% of Brazil's soybean exports to China. So the southern ports are a far bigger deal. This would turn into something that the market cares about for one of two reasons. The first reason would be it gets so bad that shipping is disrupted to a point that China and other countries have to come to the United States. I don't think that's happening. We have seen no evidence of that. The second thing that could be an issue is if the rains don't turn on again in October or November, as they typically or normally do. The rains don't turn on again, then you've got yourself a South American weather story. Last year, 2023, the soybean market rallied sharply in November and ultimately peaked on what I would call a Brazil crop scare event. So that's what you've got to look out for. As it relates to weather and how we handle weather, we're going to start to shift our focus away from U.S. weather and toward Brazil here during the coming weeks. They start planting soybeans. Early soybean planting is going to be in a couple weeks, and it persists from September really through like December. So it's a long window. It's a long growing season. The drought may be an issue, but again, it is the dry season.
Inflation has fallen to its lowest level since 2021. The July Consumer Price Index increased by 2.9% compared to the same period last year, down from a 3% increase in June and below analyst expectations of a 3% increase. On a monthly basis, consumer prices rose 0.2%, which was in line with expectations. Yesterday's friendly CPI data, coupled with the PPI data released on Tuesday, paves the way for the Federal Reserve to cut interest rates in September. The Fed is also under pressure to cut rates due to indications that the labor market may be weakening too much. As of Wednesday morning, the CME FedWatch tool was projecting a 57% chance of a quarter point rate cut and a 44% chance of a half point cut.
I'd love to see some big interest rate cuts for you guys. I just don't know if this is going to be enough to impact operating notes for next year or anytime soon. Make no mistake, CPI, the basket of goods and services tracked by CPI, is still at an all-time high and was last month. It just so happens that the rate of inflation has slowed to 2.9%, which is the lowest since March of 2021. When you look at the changes in prices of certain things over the last 4 years, this is Charlie Bellello on Twitter. He did a nice job of compiling this. I mean, everything's up from medical care to new cars to food to shelter. I mean, it's all up 20, 30, 40. Look at gasoline up 60% over the last 4 years. So no, nothing's gotten cheaper. It's just the rate of inflation is cooling. The annualized stuff, not nearly as bad, and some things are actually lower. When it comes to the Fed has what they call a dual mandate. The Fed cares primarily about two things. The first one is price stability, and that's inflation. They feel like they've come to a point where they've tamed inflation and that price stability has returned. Therefore, they are now going to shift their focus to the second part of the mandate, which is maximum employment. We've seen an uptick in the unemployment rate, and that is what the Fed is going to tackle now with the rate cuts that are very likely coming in September.
So if you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about yesterday's video with Brian Split?
Brian was on yesterday. Brian is absolutely fantastic with charts. We talked about corn, soybeans, meal, wheat, talked a little bit about next year. I'll say this about Brian's videos. You're either watching this or you are underinformed. The stuff that he puts out is so absolutely fantastic that if you're not watching it, you're just missing the boat. That's what I'll say about it. Go to standardgrain.com, sign up this morning. I will forward you a copy of this morning's email, which includes that video with Brian, along with our 6 most recent premium videos. We also have a lot of other charts and graphics, grain marketing info. Today's premium video is going to be a grain marketing review. I'm going to run through every cash sale I've advised for corn, soybeans, wheat, old crop, new crop, talk about some forthcoming targets that we're going to be working with. Sign up today, guys. $50 per month. Cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. Give that deal a shot this morning.
NOPA will release July crush data today. Traders estimate that NOPA members crushed 182.4 million bushels of soybeans in July. If realized, the crush would be up 3.9% from June and up 5.2% compared to July of last year. It would also be the largest July crush on record. Soybean oil stocks, as of the end of July, are forecast at 1.6 billion pounds. If realized, stocks would be down 0.8% from the end of June, but up 5.3% from July of last year. Also, stocks would fall to the smallest end of month supply since January. That report will be released here this morning at 11 Central Time.
We've seen record crush prints more often than not, and you're going to continue to see that. USDA projects that we will crush a record amount of soybeans in the United States during this forthcoming marketing year. We already crushed a record amount this year, I believe. And you guys have been told that this is what's going to save the soybean market, right? And it is and it isn't. I mean, the demand via crush and domestic processors is increasing. It just has not been enough to offset reduced exports and huge crops in both the United States and Brazil. It's absolutely going in the right direction. It's just not enough.
Early morning rains pushed across parts of Iowa, Minnesota, Missouri, Kansas, and Illinois. Rain totals over the next 5 days will be scattered across the Corn Belt. The 5 to 10 day period introduces slightly more rain, but still leaves many areas dry. Temperatures are slated to run normal to below normal. The Euro model shifted cooler yesterday and this morning and now indicates below normal temperatures for most U.S. corn and soybean areas during the 5 to 10 day period.
This is just benign. There's no threat here. I think the only way that you run into a U.S. weather story now would be some sort of late season weather anomaly, flooding, early frost, something along those lines. There's just nothing in current or forthcoming weather that looks to be threatening to me.
U.S. ethanol production increased last week. Weekly output of 1.07 million barrels was up marginally on the week and up 4.8% versus the same week last year. Ethanol stocks were pegged at 23.4 million barrels. The print was down 1.7% compared to the previous week, but up 2.1% compared to the same week last year. Implied gasoline demand was up 4% compared to the previous week, but down 2.8% versus the same week last year. On average, over the last 4 weeks, implied U.S. gasoline demand is up 1.4% compared to the same period last year.
Ethanol production is very strong. It's fantastic. The problem is that it just doesn't really move. It's seen as being a steady portion of the demand base. USDA is projecting that ethanol, or corn demand via ethanol rather, will be flat year over year this year versus the forthcoming marketing year. So it's great. It's just not enough to move the needle when it comes to the balance sheets because it doesn't really change a whole lot. What can move the needle? Exports can move the needle. And who can do it in a short period of time? It's China. Love them or hate them. We desperately need them right now. Look at the markets, guys. We need some demand. What did cattle do yesterday?
Cattle futures were high again. Feeders higher. Feeders were up $1.35 to $2.17 higher on Wednesday. Live cattle were up 50 cents to $1.37 higher. Box beef lost a little bit of ground yesterday. Choice ended the day at $314.88. That was down $2.05, and select ended the day at $300.50. That was down 11 cents.
Outside markets fairly quiet. U.S. dollars about flat. Stocks are a little bit higher. Bonds are off a little bit. Gold's up $15. Crude oil is up 39 cents, and the October WTI at 76.23. Have a great day, guys. We'll talk to you Friday.